Okay, we're talking about ASPE. What's the difference between ASPE? And so let's talk about ASPE impairment. For ASPE, we do something a little bit different. So we're looking not at a cash generating unit, but we look at a group of assets. So an asset group. And an asset group can actually include not only the assets, but also the liabilities. Okay, the liabilities which are associated with the asset group. So keep that in mind. It's very different than a cash generating unit. A cash generating unit cannot include the liabilities, but under ASPE, they can include anything that's in the asset group, and that includes cash inflows as well as cash outflows that are related to the asset group. So let's give an example. Let's say the asset group is land, a building, plus equipment, because it needs all these assets in order to generate revenue, right? The building has a mortgage. So what's going to be, it's going to be the value of the land plus the value of the building plus the value of the equipment minus the value of the mortgage, because the mortgage is connected specifically to the building. Okay? So now, let's also talk about when we have to do impairment testing. For ASPE, just let's remind ourselves, for IFRS, every single year we had to look for an indication of impairment. So we have to actually go out and look for this. That's not true under ASPE. Under ASPE, you don't look for indicators of impairment unless there's some event or circumstance that leads you to question the asset's value. Okay? So do not search for indicators of impairment. That's for IFRS. You do that. Instead, really, unless an event or circumstances lead you to question the asset's value, do nothing. Okay? So there has to be something that comes to your attention. Okay? Now, then what do? Let's assume, let's do a quick example under ASPE. So let's say we have a, let me think. Let's say we, I know. Okay, so this is it. So we have a asset equipment valued at $420,000. I'm going to use the same example as I did for IFRS. 6 years, end of year 2. Okay, we're at the end of year 2. Accumulated depreciation is $140,000 at December 31st of year 2. All right, so now we've got the undiscounted cash flows is equal to the recoverable amount. So the recoverable amount is only one amount. And remember from our old question under IFRS, it was $50,000 for 4 years plus $20,000 salvage. Okay, undiscounted though. So we're simply going to say it's $220,000. It's $220,000. That's what it is. So now I've got to compare the carrying value to the recoverable amount. Carrying value is, of course, the 420,000 minus the 140,000, which is equal to $280,000, and the recoverable amount is $220,000, so impaired. Therefore, it's impaired. If the recoverable amount was $290,000, we would do nothing. But in this case, it's impaired. So we have to write down to the fair value. So notice we don't write down to the undiscounted amount. We write down to the fair value. So what is the fair value? Is it fair value less cost to sell? They don't describe it in the standards. The fair value is considered the value that you would receive in an arm's length transaction. So, I mean, it could be this is a matter for professional judgment. So let's assume that this fair value is, let's say it's $180,000. Okay, that's what we think the fair value is. Now, again, is fair value less cost to sell? That's a matter for professional judgment. It simply says fair value, and how you determine fair value, they give you a few examples, but that's all it says. It doesn't say what that means. All right, so now don't forget, I'm sitting at 280, so I've got 280,000 minus the 180,000. I need a write down of $100,000 is the write down. So now what am I going to do? I'm going to do a debit to the impairment loss of $100,000 and a credit to accumulated depreciation, $100,000. And now let's do the T accounts at the end of year 2. This is the equipment. It would still be sitting at the 420,000, but here it's 100. This is accumulated depreciation, 140,000, and then we're going to do the write down of 100,000. So this is 280,000. I hope I did that right. I think I did it right. So now what's the carrying value? It's the 420,000 minus the 280,000, and that should equal, I don't know what it equals. I think I did something wrong here. If I did, I'm going to be very disappointed in myself. No, it's equal to 140. Oh no, the fair value was 180,000. What did I do wrong? What did I do wrong? What did I do wrong? Okay, 280, 123 minus 180, 123. No, it has to be a $100,000 write down. So I did the $100,000 write down. Did I do something wrong here? 280,000. So the 280,000 minus the 180,000 is a $100,000 write down. So I'm going to write it down by 100,000. Oh my gosh. Hello, stupid. Oh my goodness. I don't know why I wrote that. Don't even ask. Don't even, I looked at, don't ask. I don't want to know. Okay, so this is $180,000. Exactly what I want it to be. Now, let's move on to year 3. Let's say the value recovers to 200,000. What are we allowed to do? No reversal of write down allowed. Under ASPE. There we go. So that is impairment testing for both ASPE and IFRS.